Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, August 3rd, 2025, we're dissecting the recent volatility in the USDCAD pair, a currency cross that has been significantly impacted by a flurry of news events. Let's begin by setting the stage with the latest market narratives. Recent Google searches reveal that the US dollar has come under strong selling pressure. This weakness is primarily attributed to dismal U.S. employment data, triggering increased expectations for further interest rate cuts by the Federal Reserve. Specifically, UBS analysts are now forecasting USDCAD to decline towards the 1.34 to 1.35 range in the second half of 2025, signaling a bearish long-term outlook. However, there's a counter-narrative. Canada was reportedly hit with a 35% tariff effective August 1st, which would typically weaken the Canadian dollar and thus be bullish for USDCAD. Despite this, the overwhelming influence of the U.S. jobs data clearly dominated, leading to a significant reversal in the pair's trajectory as evidenced by its drop below the 1.3800 level on Friday, August 1st. Now, let's transition to the charts to see how these fundamental forces are manifesting. Looking at the daily chart, we observe a broad upward trend throughout most of 2024 and early 2025, with USDCAD previously attacking the 1.3860 resistance level. However, zooming into the last few months, specifically from March 2025 to the present, a significant shift becomes apparent. Notice the series of candles peaking around 1.44 to 1.45 in late 2024 and early 2025, which established a strong resistance zone. More recently, the price has generally been fluctuating within a tighter range, frequently testing the 1.37 to 1.39 levels. The most recent candle, representing price action for August 1st, 2025, is a large bearish candle, opening near 1.3857 and closing significantly lower at 1.37816. This sharp decline perfectly aligns with the news of dismal U.S. employment data causing the USD to tumble. To truly grasp the speed and intensity of this recent move, let's shift our focus to the 1-hour chart, specifically examining the period from July 29th through August 1st. We can see a relatively stable period around the 1.37 to 1.38 mark, with small hourly fluctuations indicating consolidation or minor directional biases. However, observe the candles leading into and on August 1st, particularly from the 12 o'clock Universal Time coordinated mark onwards. There's a rapid sequence of strong bearish candles with increasing volume, confirming the sudden and decisive selling pressure on the US dollar. This granular view reveals that the drop was not a gradual erosion, but rather a concentrated sell-off, likely triggered directly by the employment report release. The high of 1.38791 on the daily chart for August 1st was quickly followed by heavy selling, pushing the price well below the key psychological level of 1.3800. For an even closer look at this critical price action, we can dive into the 15-minute chart, narrowing our focus to the period of intense selling on August 1st. Beginning around 12:25 Universal Time coordinated on August 1st, indicated by the timestamp 1754051100000, we witness a pronounced downward cascade. Successive 15-minute candles show lower highs and lower lows, painting a clear picture of strong bearish momentum. The initial large red candle from 12:25 Universal Time coordinated on August 1st had a high of 1.3875, plunging to a close of 1.38284, demonstrating the immediate market reaction to the news. Subsequent candles continued this trajectory, breaking through minor support levels almost instantaneously. The volume during this sharp descent also increased, reinforcing the conviction behind the selling pressure. This micro-level detail underscores the urgency with which traders reacted to the fundamental news, overwhelming any potential bullish counterarguments from the Canadian tariff story. Returning to the daily chart for a broader perspective, let's discuss key price levels for trading decisions. The immediate resistance is now the 1.3800 psychological level, which the pair broke below due to the USD weakness. Above that, The previous high before the plunge, around 1.387 to 1.388, will serve as a significant resistance point. On the downside, the low of the August 1st candle at 1.3761 now acts as immediate support. If this level breaks, the next major support zone to watch will be around 1.3700, followed by the 1.3600 to 1.3650 area. Looking further back, the 1.3538 level, from which Action Forex noted a corrective rebound, could also provide historical support. It's crucial to acknowledge the extreme outliers in the historical data, such as the flash drops to 1.26, 1.29, or even 1.09. While these are present in the data, they represent highly unusual, possibly erroneous, or flash crash type events, and are typically not indicative of the pair's regular trading range, which mostly resides between 1.35 and 1.45. So, are we bullish or bearish on USDCAD moving forward? In the short term, the market's reaction to the U.S. employment data paints a clear bearish picture for USDCAD. The strong sell-off on August 1st suggests continued downside momentum as traders price in future U.S. rate cuts. However, a technical rebound or dead cat bounce is always possible after such a sharp drop, especially if the 1.3761 level holds temporarily. Long-term, the bearish sentiment is reinforced by UBS's forecast for USDCAD to decline towards 1.34 to 1.35 in the latter half of 2025. Reasons to be bearish include ongoing weakness in U.S. economic indicators and sustained expectations of Fed rate cuts. Conversely, a bullish reversal, though less likely in the immediate term, could occur if upcoming U.S. economic data surprises to the upside. Additionally, any escalation of the Canadian tariff situation, which intrinsically weakens the CAD, could provide some underlying support for the USDCAD pair over time. To recap, the immediate price levels to watch are the 1.3761 support and the 1.3800 resistance. A sustained break below 1.3761 increases the likelihood of a move towards the 1.3700 and potentially 1.3500 to 1.3400 zones. Aligning with the long-term bearish outlook from UBS, we estimate this has a 60% likelihood if further U.S. data confirms economic slowdown. Conversely, reclaiming 1.3800 and especially 1.3850 would signal a short-term bullish correction with a 40% likelihood, particularly if the Canadian tariff impact becomes more pronounced or U.S. data shows resilience. Look for upcoming U.S. inflation reports, additional employment figures, and any statements from the Federal Reserve regarding monetary policy. Also, keep an eye on Canadian economic data and any developments surrounding the tariffs, as these could influence CAD strength. Volume analysis alongside price action remains crucial. Unusually high volume during breakouts or breakdowns will reinforce the validity of those moves. Always remember to manage your risk and consider multiple timeframes before making any trading decisions. That's all for today on Explain the Charts. Stay safe out there and happy trading.